Hello everybody, my name's Drew Demon and I'm the Devil's Stockbroker. This video I'm going to be updating you on Revlon, ticker REV, and the squeeze that's currently going on with it. This is a combined short and gamma squeeze that started a couple of weeks ago, and recently they had a pop in their stock price in the past week, and it looks like the strength is continuing. So I wanted to update the community on what's going on with this current ticker and see what we can look forward to and what the possible bullish and bearish scenarios are going forward into next week. All right, everybody. So first off, let's go get the TA out of the way. The first thing that we're looking at is Revlon was setting up a channel of consolidation beginning here, and it broke out on the news that they had received their $1.4 billion bailout package in the form of a loan court approved by their bankruptcy court. Upon this breakout, the immediate response was for the rest of the day, it had volatilely spiked up and down between $8.50 and a maximum of $11, or actually more like $10.75 at the high. So the volatility had this stock ticker bouncing around by a solid $2 after it had made an already 300% move. Moving down to the 10-minute, we see that we started ranging down here and set up a symmetrical triangle pattern, which it appears that we are beginning to test. At the moment, we have these two descending levels of resistance. This is the one for the triangle, which I was pointing out. This is the immediate pullback after we had seen REV make its large move up to $10.50. After entering into this range of consolidation, it established a pretty solid level of support just under $7.50, which if you watch my live stream while this was going on, that was the level of support that I had called out as being the most significant due to the large number of call options that were in the money at that level. We'll get to that later. Currently, the most significant level to break for Revlon is $10 even. The reason for that is because of a combination of a large number of options that have been put onto the chain, as well as this is the area that we had bounced off of and attempted to break through on two separate occasions here during the middle of the 2nd of August, and then again in the afternoon trading session later that day. So after falling down and retracing, establishing a new level of support, this is exactly the level of strength that we needed to see from Revlon going forward. Two possible scenarios that I see coming up ahead for Revlon is for it to first get stopped here at this level at $9. If Revlon can't get above this $9 level and sets up bearish patterns such as double tops or even a head and shoulders pattern, then I expect it to come back down to retest 750 one more time. If it can hold up 750, then it's likely that we will enter into range-bound consolidation for the remainder of the week until a new level of volume brings us either to the upside or to the downside. So this is the range to watch going into next week. We also have earnings coming up, which is going to be pretty significant for Revlon here. The time for the earnings announcement has not been established, so this may be subject to change. Second reason why the $9 level is the most significant is because we've tested this range before, and this is where we had gotten stopped previously when we made the first move up to this level. So this was the rejection that we received at $10 and then dropped below $9, tested it one more time, couldn't get above, broke down, tested it one final time or got pretty close at about $8.75, and then the chart broke down. So if Revlon can't make this new pull above $9 and continue to close up higher and higher throughout the week, then this is going to create a problem for us. The reason why these levels are the most significant is absolutely tied to the options chain. The options market is driving a good bit of this volume, and very shortly I will show you why. First things first, let's check the gamma ramp. Revlon currently sitting at about $8.60 per share, puts about 44.7% of the float in the money. Now, as I had mentioned earlier on this week, 100% of the float is on the chain. In fact, more than that, 200% of the float is on the chain, all the way up to $35. Now, these strikes were added later on. So currently, what you're seeing here at these much larger strikes is market makers seeking liquidity, and they're doing this in order to try and shove the price down. These are a giant trap. They're totally worthless to you. Gambling on those distant out the money contracts is totally pointless without enough momentum to drive the price up past these levels first. So, the first barrier that Revlon needs to get past is $10. Once we cross that threshold, 75 to 80% of the float goes in the money, and it's bye-bye for the market makers. This is one of those situations where buy and hold mentality is the only thing that's actually going to put enough pain on the market makers to squeeze this thing. Now, I'm not saying that advocating that people ignore risk and keep buying something and holding it no matter what happens. What I am trying to point out is that once you get up to these levels, selling out of shares only causes the price to decline. And from there, greater weakness is shown in the chart, and that can cause the entire squeeze to fail. And this is the risk that we are facing as retail traders, is that other institutions or other retail traders that do not have that kind of conviction or risk tolerance can end up causing the squeeze to fail. So that risk is there. You have to realize it, and you must recognize that anything can happen in this scenario. Next, we'll go over the levels of open interest that are the most significant. The big date is August 19th. This is where most of the contracts that are in the money are going to have the most significance. The second date, the most important strike, I should say, is $10, because $10 puts an additional 20% of the float in the money going forward all the way until September. Now, once we get above $10, that's 75% of the float locked up in the options chain. And as long as retail continues holding, or better yet, exercising those call options, the more pain that puts on market makers and encourages them to deliver their shares early on. Or if they have not delta hedged for those options, which they most likely have if they're in the money. But nevertheless, if you force the market maker to deliver those shares by exercising your call contracts, even if it's just a few days or even a week early, that can cause the market maker to lose access to those shares. They become locked up for assignment, and then they're forced to send them directly to you, the participant who purchased those calls, and exercise them. This prevents the market maker from unhedging their position by selling shares into the market and causing price collapse. The next price level above $10 that's most significant is $12.50, above that $15, and above that $20. $19 is slightly significant due to these September 19th contracts, which are going to be, or excuse me, September 16th contracts. September 16th, we have a big pile, 8.3% of the float, or about 4,553 options contracts closing at the $19 strike price on September 16th. Now, beyond these price levels, from 20 onward, there is almost no ramp here. So this is where the risk is. Many market makers, and especially institutions, are taking advantage of the volatility to sell these deep out of the money contracts in order to gain liquidity. This is a trap in order to drive more liquidity against our positions. So purchasing these is placing money in the hands of the bears who are trying to put pressure down on the price, or at the very least is just it's a lofty goal that is not likely to be reached. If it does, if somehow we do reach this level of hitting the $35 level, then this is surely going to cause panic. But I want to remind everybody that this is an unlikely scenario. Now, going back to the charts, I've laid out the bearish scenario, the slightly bullish scenario, and now we have to go over the Super Bowl scenario, the least likely of possibilities, but nevertheless a possibility. Now, in the bearish scenario, we never break above this $9 level, and then we fail before we get to August, and you'll see price collapse from there, okay? In the neutral scenario, we range above $9 but never reach 10, and that causes the price to just go sideways until interest wanes, and then eventually the price declines again. Most likely won't fall into total collapse, but you don't know because unhedging of delta hedge positions by market makers can cause the price to fall faster than we expect it to. The next possibility is ranging and rapidly going above the $10 threshold level and then starting to rise up and up slowly, going up into the following week of August 19th. Depending on how earnings goes, this is the wild card that we do not know will cause what kind of effect this will have on the stock price. We don't know how Revlon has been running the business or what changes may have occurred fundamentally in their business model between their notice of bankruptcy and today. The super bullish scenario that I have in mind is somehow if Revlon is able to announce some fundamentally revolutionary data, something that just kicks the short thesis, just totally kicks its teeth in. If Revlon suddenly is able to break out going into earnings and open up above $15 the following morning, then this would put such a massive number of calls in the money that delta hedging for them would be impossible by market makers at that point. The amount of FOMO that would come into the stock going at that point, they wouldn't have any choice but to start buying up shares directly out of the market in order to get ahead of it and start closing out call positions that they have left open for retail to purchase. So at that point, you can have this runaway effect where the stock keeps going up and up and up. Now, I have set myself with a ceiling of roughly $20 to $23. I don't feel that Revlon can go much higher than that, but this is a very unusual situation because if you recall from what I was describing earlier, that gamma ramp shows that more than 150% of the stock's total float would be available at that point or would be in the money at that point. So this is the situation that can cause that runaway buying that I was talking about. Now, this is where things get a little bit hazy because this is entirely up to retail to set what price they're willing to sell at, what they're willing to close their call contracts at. Because the whole way up, market makers are going to be trying to close out positions here and here and here and here, anything that they can do to buy these contracts back before they go in the money. Because it's easier to buy to close those contracts than it is to buy up the shares without causing further price action against their positions. So this is like the Mexican standoff situation with retail and big institutional money. Is will retail sell out and take its gains and its profits, or will they continue to buy, hold, and soak up these calls at these significant price levels between 15, 18, and $20 and continue putting more and more contracts on the chain? So, in order to figure that out, one of the things that we need to do is look at unusual whales in order to tell us what the possibilities are. So, here up on my screen, I have unusual whales, and looking back at all of the flow on unusual whale, um, we see several things. Okay, so here we've got the chart, and this is the big move that we're watching for, right? This happened on August the 3rd, or no, the 2nd. This happened on August the 2nd. So this big move, this swung the price up, happened late in trading on August 2nd. And before that had happened, the day before, there was this massive amount of call volume purchasing more calls than there was open interest. So this move was anticipated. Somebody knew that the bankruptcy news was actually going to hit. And if you had traded on this information, then you could have made some pretty silly and ridiculous gains. As a matter of fact, I had only just had a $4 position marked on my portfolio uh, for the call contracts that were expiring that week, and that was just happenstance. The big move came later on, and I alerted Hell's trading floor within 5 minutes of the actual news of the $1.4 billion bankruptcy court loan being announced, and we managed to catch the move before it truly got running. So thanks to that quick news watch and alert, everyone was able to profit pretty nicely on that first swing. But the vast majority of this call buying here, these 1,000 size orders for $10 and $4 and $2.50, $7.50 call options, almost all bullish volume, all a full day before the actual announcement came through. So clearly somebody knew something. I'd be curious to know who, how much this individual profited, because this was a collective, like, this had to have been almost $3 million that was bet on Revlon just the day before that news had hit. So going into the following day, even more bullish volume came through. The one last thing that I noted was on the 3rd, that was after the volatility had taken the price back down to this level below $8.50. Somebody started selling these very large orders of 35 strike calls for January 2023 on Revlon. And that repeated chain activity caught my attention. Now, I suspect that this is market makers and somebody who is trying to gather liquidity and profit off of this volatility, never expecting the price to reach this level. And like I said, it's a very unlikely level to reach. However, as I mentioned, there is a huge supply crisis going on with Revlon shares. And as long as there is no dilution, and as long as nothing happens where more shares get added into the float for Revlon, which, be warned, they do have a shelf offering. They can sell shares. It is possible, but it's not necessarily likely if Revlon is aware of this situation. And given that they're currently in bankruptcy court, they may not actually be legally enabled to start selling any shares at the moment. Their equity is currently tied up in the bankruptcy court systems. So right now, they may not be able to sell those shares. Those could be locked up. This requires further study and research, so I'm not confirming that at this time. However, once I do a little bit more research with a little bit of time, hopefully I'll be able to get that update to you guys right away. The thing to watch for is continued call buying going into next week. And what is going to be important to pay attention to is the open interest change with volume. Over here I have Unusual Whale's intraday open interest analysis, or the intraday analyst for Revlon. And what we see here consistently is massive open interest volume and open interest changes. The OI and volume changes in Revlon are what are going to be the most significant. So now, as long as OI is going up, and as long as those numbers keep increasing throughout the next 2 weeks, this is bullish. The reason why is because it puts more and more and more leverage on Revlon stock. The more purchasing of open interest in call options that are, whether they're in the money or out of the money, doesn't necessarily matter, although I would say that in the money is better. The alternative is that there is purchasing going on, and if you're watching a bunch of buy orders in Revlon while the OI is decreasing, then that means that institutions are buying to close those orders, and that means that they are trying to take away the leverage that is currently set up in this stock. And right now, market makers are in a position where they have to make a choice. They either have to hedge their positions now by buying shares, they need to either hedge their positions by buying deep in the money calls, or they need to start buying to close some of their other positions that they currently have sold short. So watching the volume and the OI on Revlon's call chain, especially the in the money, is going to be most critical. As long as OI is increasing on in the money and at the money options, and that volatility continues going into the next 2 weeks, then Revlon, I believe, can continue to sustain its current price and even move further to the upside. However, if volume is increasing while OI is decreasing, then that is going to indicate buying to close of positions and that's going to decrease the volatility of Revlon as well as take away that gamma support that the stock currently has in its favor. So take very careful note of the highest OI increases, which show that $9 calls and $19 calls for Revlon on August 12th and September 16th expiration are the most significant. The highest OI increase by percentage shows that $7 calls and $16 calls in August 26th and 12th, respectively, are the largest. Now, note the OI increases show that more of these are being sold. So that is market makers selling those options in order to make money on premium. Now, as OI is decreasing, this is a bad thing to watch out for. So far, we see OI decreasing at the $8 calls for August 26th. That's the Friday after the big, the largest options expiration for Revlon. And so far, I don't see any signs that Revlon is slowing down. The concern that we need to have is if Revlon has a shift in its OI trajectory, where OI is decreasing, that open interest decreasing because calls are being bought to close them, then that is bad. We don't want that, but it's likely to happen as this squeeze continues throughout next week. So I'm going to be keeping a very close eye on this and setting alerts for unusual whales. And I'm going to try to stream next week so that I'll be able to watch this very closely and keep everybody up to date throughout the day. The last bit of data that I'll update you on is the Ortex data for Revlon right now. So the short interest value is currently estimated to be about $28.66 million with an estimated short interest of free float at 71.13 million. 71.13% of free float. That's a significant portion. More than every 2 out of 3 shares is sold short right now. So a huge portion of Revlon stock is sold short at the moment. Let's go and try and find out where these shorts currently have themselves marked. So currently watching the days to cover line, we see that there was a massive decrease in days to cover after volume started picking up. So we know that the days to cover is very, very short due to the high volume. We'll go ahead and take this away. Let's focus in instead on the on loan, average days on loan, and the total estimated short interest. These two figures combined will let us know where shorts are currently buying and adding to their positions. So throughout June, short interest had been steadily increasing, and the average days on loan from that point forward had been decreasing. What this indicates is shorts adding to their positions, new shorts getting additional shares sold short, and they are more recent shorts. More than likely, the long-term shorts have either taken profit or are still stuck in their positions, but there aren't as many of them. Right now, the short interest, let's go ahead and take a look at the short interest of free float at that time. So the estimate back here before their bankruptcy notice was 45% estimated of free float. So where most of the shorts had gotten their positions at the earliest, they were at $7.70. That is the absolute earliest that the majority of these shorts got into their positions. So they are currently underwater. Every single short is underwater on their position. They are in an extremely dangerous situation with a combined gamma and short squeeze staring them down in the face. Short interest spiked significantly in April of 2022, where most of the shorts had gotten in and quickly got out of their positions at roughly $6 and $5. After that, they scaled even further into their positions, somewhere around the $3.50 range. And then after the price had gotten driven down so far, all the way down to below $2, the short interest shot up by an additional million shares. So that added another roughly 15 to 20% SI over the free float to the current market position. This is where I would say about somewhere between 20 and 30% of all shorts are at. On average on their positions is $3 to $4. So every single dollar that this goes up is causing them to lose an additional 30% of their position notional value. And this is putting extreme pain on them right now, because right now the margin requirements on Revlon, according to IBKR, is over 500%. So whatever they have marked in their position as short against Revlon, they need to be holding more than 5 times that amount of collateral because of the volatility that's currently in Revlon. So all that has to happen is for shorts to get a margin call is for Revlon's notional value and the losses on their short position to exceed 5 times what their total portfolio value is, which can happen a lot quicker than you think. Now, here's the last part, the last position where shorts suddenly increase their position significantly. And once again, these guys are all underwater. It's roughly between $6.20 and $5.80. The short interest shot up and it drove the price down below $5.20. And then from that point on, short interest began to fall as the price went down. However, the price has since shot up, possibly because of just pure FOMO or maybe a little bit of short covering. More than likely, it's a mix of both, but we're not positive. There's no way to tell for certain. We're just kind of speculating here. So that pretty much brings us to where we are today, where we're currently sitting at a high point of $8.85, closing on Friday at $8.60. This means that every single short from April and earlier, from April and after, is absolutely underwater. It's very, very unlikely that you have many shorts that are in a happy place right now with their current position. And there is going to be a mad dash scramble to get the hell out very shortly. The other thing to take note of is the massive number of failures to deliver that happened during the actual bankruptcy notice. The amount of failures to deliver in Revlon exceeded more than 20% of its total float, which is actually pretty ridiculous. This isn't something that should be even allowed to happen in the stock market. And as a result of this, it put them on the threshold list for almost 30 days exactly. They got off the threshold list after this big move to the upside, and I suspect that the actual cause of this move was market makers realizing that they had lost and they needed to get out quickly. And it's possible that market makers left their options positions alone, or they may have bought to close them. There's no way to know for certain. However, there's a clear sign that market makers now realize that they have made a mistake and they needed to quickly cover their failures to deliver. So let's go ahead and take a look further on down at the short exempt ratio and the short exempt numbers to get an idea of market maker activity and where they're currently at. So this is the big move that happened on August the 1st. This is when most of the failures to deliver had closed and Revlon got taken off of the threshold list, meaning that most of the failures to deliver had been reconciled and handled by July 26th, I believe, because in order to come off of the threshold list, the stock has to have met that criteria for 5 consecutive trading days. So July 26th, they may have covered all of their failures to deliver, at least to a certain point. And then from August 1st onward, we see this massive spike in short exempt volume that really hasn't quite gone away. The volume and the short volume both went up massively, but the short exempt ratio is what I want you to pay attention to, where you see all these short exempts piling up here. And this is going to result in even more failures to deliver. I'm very certain that next week we're going to see Revlon get put back on the regulation short threshold list, which is going to indicate that market makers are still stuck and they can't get out. And this should be a big, glaring neon sign for retail investors that every short in Revlon is absolutely fucked right now. These guys have screwed up badly. They are so far behind on their positions. Every single short, at a minimum, is in the red right now. And most of them are staring down the barrel of a gun right now because they have more than 150% of the total float that is about to go in the money if this stock runs to $20. Right now, just $10, less than $2 from where we're currently sitting at is enough to put 75% of the total float in the money, which is going to cause a supply crisis because there's no way, absolutely no way, that all of those calls can be hedged for. And if retail catches on to this, if we figure this out, then there's just the FOMO alone is going to drive the price up faster than shorts can cover. They are so backed up against the wall. All that has to happen is for people to just keep buying shares and call options at the money, and these guys will be absolutely fucked. They, at this point, retail is in full control of the price. Bulls have so much control right now that if FOMO does kick in, and I'm not suggesting that you should, that's a really reckless trading strategy. I just want that to be said before we go on any further. But just FOMO alone has the power to drive this stock so high right now. I do still feel like $20 is probably close to the ceiling, because at that point, I feel like volatility halts and halting on the options chain is likely going to kick in, just like they did with Redbox, just like they did with AMC and GameStop back in January 2021. The OCC and the exchanges are absolutely not going to let this keep happening to them. It's screwing them over. It's screwing their clients over, and they keep getting caught in these extremely bad over leveraged positions repeatedly. They keep making this mistake, and every time they do, in order to cover it up, they turn off the options buying and they turn off. They switch it to position close only. So if they turn off the buy button again, then that's basically your signal that it's over, that the play's done. But until that happens, I'm very keen to put more and more and more pain on market makers and brokers that absolutely screwed up here. The shorts that got into this position and didn't get out when they realized that Revlon was going to be saved by the bankruptcy courts. They miscalculated badly, and this is an opportunity for retail to profit off of their stupidity. All right. That's it for my soapbox. I appreciate you sitting here and listening to me rant about the possibilities and the opportunity here in front of us with Revlon. I'm looking forward to seeing where the price goes in the following week, and uh, I'm hoping to be pleasantly surprised. But I do want to warn everybody that anything can happen in the stock market, and nothing about this is a certainty. So if you are going to play this, know that it is an extremely high risk play. If you are jumping into this, you should at the very least be hedging yourself with some sort of put position, some kind of insurance to make sure that you are protected from volatility in either direction. Don't just jump into this headlong, and please don't bet any money that you're not willing to lose. All that being said, thank you so much for watching. I look forward to seeing you guys on Monday, at which time we will have a hell of a time in the markets.